Hello everybody, welcome to our discussion about really getting into how we actually develop what it costs to make our product. So we've talked about cost behavior, all right, and you've applied that in cost volume profit analysis. You've used regression to estimate fixed and variable costs. We have an idea of how they behave. Now, and we've talked about that there are multiple types of inventory, and that costs flow from raw materials to work in process to finished goods. Now the next several chapters are going to be about the idea of how do we figure out how much cost goes in work in process, how much cost goes in finished goods, how much, and ultimately our goal is to get a cost per unit, right? And be able to record that when we sell that unit on the income statement. So now it's not just to put it on the income statement. We also want to make decisions used on how much cost it costs to make a particular product. And we want to make sure all the time that we don't spend so much time trying to nitpick small differences in cost that we lose the big picture, that we need this decision material quick enough, all right, and we need it such that we can make decisions, and we don't want to spend more time getting the information than the information is worth. So we're going to this, and if we don't utilize the tools that we're going to work on and that we develop, if we don't use our understanding of how much it costs to make a product to manage it, to try to reduce it, to try to get more efficient, then we really haven't utilized it very well, okay? And so that's certainly part of that decision-making process, is how do we make it as efficient, our process, as possible. All we need is know what to sell. Remember, we talked about, or one of the decisions we do is contribution margin determines whether we sell product A or B. Well, that's all based on knowing that feeling comfortable, we know what the costs are for A versus the cost for B. All right. We need to be able to set prices. We talked about and whether or not we can sell at a target price or whether we can make a profit at a particular price. What should we sell, especially on something that is new, so we start to understand what our costs are currently. Then when someone comes to us with a new product, a new opportunity, we have a good idea of how to apply those principles to projecting what it would cost to make something new. All right? So it goes way beyond just knowing what goes in the inventory, what goes on cost of goods sold. So here's the added piece that we've tiptoed around. We've talked about manufacturing overhead, these indirect costs, okay? But we haven't really got into the idea, okay, if we make two products, two whatever, two jobs, it's relatively straightforward to determine how much direct materials and how much direct labor alpha and beta our two projects use. But our manufacturing overhead, these indirect costs, by definition, are hard to trace, are difficult to find some specific relationship. And therefore, we have to come up with, as best we can, an allocation. That requires estimation. That requires kind of thinking through what makes that cost happen, why those manufacturing overhead costs are going up or down or changing. So we need to make sure that we include the right ones for the right reasons in our decisions. Okay, and this kind of repeats what we've already talked about. So a repeat of what we had principle earlier. We start with our beginning balance. We add what's added. Okay, the generic term is transferred in. This is new stuff that we started working on, and then what gets finished in this particular process goes transferred out, and then we have what's left is our ending balance. That applies, and we've applied that to raw materials, work in process, finished goods. Now we start talking about how to apply those dollars to those pieces. So starting with a very easy example where we don't have any work in process. So we're really going, okay, skipping a step, if you will, or pretending that that step is very short or that there is nothing left over at the end of the accounting period. So we completed 100,000 and that all was done. No partially done stuff at the end of April. So we just simply add up our materials, labor, and manufacturing overhead. Since we're only using one product, we're only making one product, and we don't have any work in process inventory, then obviously all the costs, including all the manufacturing overhead, were used to make that 100,000. So when we are asked what are the costs, we simply say we had $1 million that went into finished goods, work in process, and then that whole $1 million went to finished goods, right? We produced 100,000 gallons, so that's $10 each. Very straightforward to figure out if we want to know our cost per unit. Straightforward to figure out the total cost, which is what we make our journal entries for, but cost per unit, the $10, we didn't have to make any allocations or anything, any estimates really. Okay, in this case, all of it went to make the finished goods, and therefore, you know now the cost per unit. You can use that for pricing decisions. You can not use that to record cost of goods sold in any way that you would like. Now, adding you might say, a complicating factor. So now we're in May, the next year, or next month, I should say. Okay, we don't have anything in work in process, but in May we start 110, but we only transfer out 90. So in this case, some part of it is still being worked on. So now we have the added issue of taking the cost and allocating it somehow between what's got finished and what is still being worked on. So we know, just as a graphical thing, 90,000 went to finished goods. We still have 20,000 gallons, and they are halfway done, halfway through the process. So we introduced the idea that when trying to allocate costs, we kind of need to put everybody on the same page. And so we take that 20,000 gallons that is half finished, and we say to ourselves, that's the same as 10,000 gallons all the way finished. So that's the idea of equivalent units. That's going to come back multiple times over the next chapters, okay, as we add to the complexity of it. But this is a very simple example that says, okay, if we want to make that 20,000 gallons on the same page as the ones that are completed, we simply adjust it to equivalent units. So what we really did during the month is we had 90,000 gallons that were completed and transferred, and we have 10,000 equivalent gallons, all right, with the same work, materials, and everything as a finished product that's still sitting in work in process. So we have 90,000 transferred out, 10,000 equivalent gallons. So our total is still 100,000. We take our costs, direct materials, direct labor, manufacturing overhead, nice round numbers, add them up, 990, and we divide by the equivalent units, not the whole 110, but the 90 plus the 10, the 100, and we get $9.90 per gallon. So when we make our journal entry, when we transfer our cost of finished goods, we're going to transfer 891,000. We're going to credit work in process 891,000. We're going to debit finished goods 891,000. And that's the 90,000 gallons that were physically transferred times the $9.90 per gallon. So we've now taken these costs and allocated them. Okay, we're using an estimate because that 50% complete is an estimate between those things that are finished and those things that are halfway finished. So that means that there's still a dollar amount in work in process. We know there's 10,000 physical gallons there, but from an accounting standpoint, there's 99,000. Those 10,000 gallons, or 10% of the total, okay, represent $99,000 of cost, $9.90 per unit. So if you think of your vouchers, your account, your T account, your work in process, you got a debit for 990, you credit it for 891,000. Your ending balance, your debit ending balance would be 99,000. Now, that was all we needed to do is allocate between finished goods and work in process. What if we had, because we only had one product, what if we have more than one product? All right? Again, the idea of how much direct materials and direct labor is used by each of those should be relatively straightforward, meaning it should be fairly obvious if you're working as a direct labor person, okay, on S72 or S66, and you should keep track of that. You should be able to see, that's what we mean by traceable, the direct materials that are used in S72 versus those that are used in S66s. Now, if they're very, very similar, that could be maybe harder than it sounds, but we're going to go with that these are enough different items that it's not that difficult to tell the difference between which products. And if there are any complexity at all, we literally have a list of what materials go into each of those, each of the direct materials. And for that matter, what direct labor, what processes have to go into making a S72 versus an S66. What gets a little bit trickier is this manufacturing overhead, because now we have to allocate how much of my manufacturing overhead was for S72s and how much for S66. Because it's indirect, it's not traceable. We have no specific information. There's nothing to kind of look at and say, okay, that is exactly how much manufacturing overhead it used. So we come up with an allocation. In this case, we're looking at the possibility of allocating that manufacturing overhead based on the direct labor hours. So we look at what direct labor hours S72 used, and we look at the direct labor hours that S66 used, and we allocate accordingly. So we'll show you how that we might think that through. So here's an example of how many we produced. Looks like we changed our 52s to 27s and 66s units produced. Direct labor hours to do the S27s. Direct materials, direct labor, easy to allocate between the two products. Manufacturing overhead kept over here to the side because we haven't yet allocated that $252,000 between the two products. So if we really want to know what cost to make S27s or S66s, we need to have some way of allocating that $252,000. All right? So we've already allocated direct materials and direct labor, as is shown on here. That's easy. Okay? So how do we do it with overhead? So we introduce the concept of a predetermined overhead rate. Notice the term predetermined. That means we've determined it before the accounting period started, before we got into doing our products. So we look at the estimate ahead of time. And we're going to take the estimated overhead cost and divide it by the estimated base. And that's going to give us our predetermined overhead rate. All right? So as it shows right here. And the question we want to ask ourselves is, the allocation base should be an activity that has a logical relationship. It may not have a direct relationship, but it has a logical relationship with the overhead costs that we're looking at. If we're looking at all the overhead costs, what would determine, okay, how much overhead each product used? Okay? So we have to do this as an estimate, and we have to do it ahead of time, because during the accounting period, some overhead costs, some indirect costs happen in chunks, meaning you pay rent at the beginning of a month, or you calculate depreciation on machinery, or you have repairs that happen, let's say, on at a particular time. There is no way that repair applies to all products, those that are being made right then, and ones that are going to be made next week and the next week after that, and even the week before that. Okay, so we don't know what the exact amount is, and we need to have this information right now, not at the end of the accounting period when we know all the costs. And we need to not have the amount that's allocated to overhead be based on what happens with overhead costs that particular day, because they fluctuate. Okay, some days, you know, when you're making product, you're not paying your overhead costs as they come off the assembly line. Okay, so an example of how we might do that. We take that estimated overhead cost of $252,000. We say, all right, we think that the more the direct labor hours, the more people that are working on each of the products will kind of tell us how much work is done and therefore how much overhead they should have. So S66s have more direct labor hours, S72s have less. We would expect more overhead costs for 66. That's the logical determination. We think that this is a good activity, a good what we call cost driver. And so we're going to take the $252,000, divide by 6,300, and we get $40 per direct labor hour. So the idea is we have people working on these products, and we're going to pay them direct labor, right? They get paid. But then there's these other costs that happen, this overhead that happen, that we're kind of estimating happens because of that direct labor. Okay? And those overhead costs, not money that we're paying to the employee, but things we pay for other stuff that supports that employee, is another $40 for every hour those employees work. And again, that's an estimate. We don't know what that is for sure. Therefore, if the 252,000 is the total overhead, we're going to allocate 2,400 times 40, or 96,000, to S72s, and 156,000, or 3,900 direct labor hours times 40 to the S66s. That gives us a different per unit cost, okay, for S72s versus S66. So we know what the direct materials, direct labor were simple. However, don't ever forget that those costs are still important. We always spend more time worried about and calculating and allocating overhead, but don't lose sight that there are still direct costs that need to be considered. When we allocate the overhead, okay, 96 to S72, then we take our total cost for the S72s and the total cost for S66s and divide by the units produced. And so our S72s cost us 2,600, all right, or estimated, and then 270,000 divided by 240, 1125 for S66. That's our estimate based on that allocation of overhead. Now, we're pretty sure about these direct materials, direct labor, but we understand that this overhead was a big estimate. So we understand that the choice of what we use, direct labor hours in this case, was a little bit arbitrary. There's no perfect answer. If we used maybe we used direct labor cost, which isn't much different than direct labor hours, okay? And so you take the 252 and divide it by the total direct labor cost. The total direct labor cost is 150,000. So the direct manufacturing overhead is 168% of the direct labor cost, or 1.68 times that. Add it up and you see that you get a different cost per unit, but not substantially different. Okay? Because you're still using a measure of direct labor. What if we get even fancier? We decide that maybe our overhead can be broken into smaller pieces. All right? And so we're going to break our overhead into two pieces first and then allocate those. That might look like this. We take our total manufacturing overhead and we do a first stage. We allocate some overhead. And again, remember, we're doing this before we've even made anything. This is all an estimate. We look at our manufacturing overhead costs for the last 3 years or some of the things we've already had, and we say, okay, these are machine related, so it makes sense that we use more of those costs when we use our machines more, and these manufacturing overhead are more about people, and therefore we're going to use more of those overhead costs when we use more people. So we're going to then take our machine-related costs and allocate, maybe using a different allocation base. Machine hours in this example. We're still going to allocate to the S72s and the S66s, but we're going to then take the others. And now, a couple things to remember. The direct labor-related costs and machine-related add together to manufacture. It's the same cost we were talking about before. But we're trying to add some ways of thinking about it a little better, and maybe we'll get a better estimate. If it's not a better estimate, then this is just extra work. It's got to be, we got to feel like it actually captures our costs and gives us better information. Otherwise, it's not worth it. All right, and we're going to look at this in far more detail as we get to especially to activity-based costing in a couple of chapters. All right, so 2 stages means we allocate first to 2 different cost pools that add up to our total overhead, and then we have maybe a different cost allocation rule for each of those. So in this case, you end up with 100,800 of machine-related overhead divided by 5,600 machine hours. That gives you a, and you can hear this term if you work in a, you'll hear the term burden rate often in a manufacturing environment, because that's the terminology that a lot of manufacturers use, especially when they're talking to the people who are actually doing the work. Okay, and it's the cost for having the machine operating. Okay, or at least our estimate of that, because that's an indirect cost and hard to trace. But remember, machines don't get paid. That's in addition to the money we have to pay for someone to operate the machine. This is the machine cost, the electricity, the maintenance, that sort of thing. And we have the other part of the overhead was related to direct labor hours. We divide it by 6,300, we get a burden rate of $24. So then when we have to allocate between our two products, okay, we then take this amount per machine hour and multiply it by the machine hours that S66s use. And then we take the direct labor hour rate times the number of direct labor hours that the 66s use. So in this case, these two numbers were developed by doing that. Total allocated overhead, 169.2 for the S72 is 82.8. Those still add to that 252, right? But because of how much they use in terms of direct labor hours or machine hours, the amount of overhead is allocated a little differently than when our earlier estimate. Again, the idea is to get as close to as good an estimate as we can get by giving it a little more detail here. So you might, when you look at it, you might do your overhead. Here's our direct materials, direct labor, still the same, still done the easy way, still important. But now we have our overhead allocated by two cost pools, machine related and labor related. Add them together, get our total overhead. And so now our S72s have a total cost of 194.8, S66 283. Divide by the number of units again, and we get our unit cost. And it's different, again, than what we did when we allocated it once without using a two-stage. And again, we have to decide, is this better? And is it better enough? Is it enough better information to justify that extra work? So as we move forward to Chapter 7, we're going to learn about job costing. Job costing is one of kind of the overall formulas about how to keep track of what's in work in process, what's in finished goods, that sort of thing. And that's where we have what's called discrete jobs. You have a start and an end, very specific to a customer, projects that we are easily able to differentiate between one project and another. So, good examples. A home building, okay, you know that that's for a particular customer. You do exactly what they ask for. All the materials, all the labor can be directly tied to that job, okay. You know when it starts, you know when it ends, all those good things. Process costing is more of an assembly line, okay, situation where you have this continual flow. There is no specific customer when you're making it. It's not customized. All of them are done the same. They all go through the same process. Okay, there's no real start or stop to the process. Many of these types of manufacturing run literally 24/7 because it takes a lot of time and effort to get it started. So once you got it started, it just runs because there's a lot of machinery. Okay, it just goes, and you don't want to stop it, all right, and change things. So you just let it achieve a lot of economies of scale by doing it over and over again. And then there's operation costing, which actually kind of hybrids. It treats the materials, okay, like job costing, because it understands that the individual materials that go into a product are very different, but they may all have the same assembly or same labor process or machinery process, and therefore you treat that as if it is the labor and overhead as if it is process costing. Okay, so it allows kind of this idea of a combination. So you do a lot of allocating of even of the direct labor and the overhead, but you still try to track the individual materials and traceable to the project.